Hey, it's Tom here and welcome back to the channel. So investment checklists are kind of a key tool in the tool belt of many of the investors that I follow. The two people that really come to mind initially are Guy Spear and Moat, but I've certainly heard other investors talk about checklists as well. People like Lee Lu, even Phil Town has mentioned checklists as well and has done a few kind of podcast episodes on that topic. And over the past couple of months, I've kind of collected various different checklists where I've been able to get the information. For example, Guy Spear shares a few of the checklist points from his own checklist in his book, The Education of a Value Investor. Phil Town, like I just mentioned, has shared various points on his checklist in podcasts. Moat has a couple of very old talks at Columbia Business School that have a small selection of points on his checklist, and there's other investors that I follow like Jason from the After Dinner Investor that has his own podcast as well. So over the past couple of months, as I've kind of collected various points and various things that people focus on, I've kind of turned that into my own checklist. I've taken sort of my favorite bits from those various checklists that I think are areas where I could potentially stumble, and I've also added in some new points around mistakes I've made in the past and things that I kind of need to remind myself personally to look at when I'm analyzing an investment. So I've mentioned that I'm doing that in a couple of previous videos, and you guys have kind of requested that I share that checklist. So that is what this video is going to be. The checklist is about 30 or so points long at this point. So this is probably going to be a two-part video, but I will try to get through each of the points fairly quickly. And I will also leave a link down in the description below as well if you want to download this checklist spreadsheet. So that includes not just my own checklist, but also the various checklists that I've collected from Phil Town and from Jason at the After Dinner Investor and from Guy Spear and so on as well. And the other thing to keep in mind is that checklists are and kind of should be by design very personal. So, the best checklist for me is probably not going to be the best checklist for you. I will have a lot of stuff on here that I just think about kind of automatically and I don't really need to double check myself on. Whereas the checklist is really designed to make sure that I have, thought about different aspects of a particular business or a particular investment. There are various parts of the investment process that, I think about automatically, and there are other parts of the investment process that I have to kind of remind myself to think about. So the checklist is really designed for the things in that second category, the things that I often forget to think about, or I have to just kind of remind myself and get clarity on. So if you see some kind of obvious things that you would think about and that I talk about all the time that aren't on this checklist, it's for that reason. I don't think I really need to actively remind myself of some things, but other things I certainly do. So with all that said, let's get straight into the checklist and I hope you enjoy. Okay, so let's start from the top. Now with the checklist, I've basically structured each of the points into kind of 5 different categories. So I followed Phil Town's sort of 4M approach of meaning, moat, management, and margin of safety. And then I have sort of a final checks section of the checklist as well. So arguably some of these questions could end up in multiple categories, maybe some in meaning, could be in moat, and others could be in management and that sort of thing. But these are kind of rough categories, and I think I've just tried to order them in a way that I think makes sense as kind of a logical process to think through these various different questions. So in this video, I will aim to get through the first 3. So I'll aim to get through meaning, moat, and management. And then in the next video, I will talk about margin of safety and kind of valuation, and also about kind of final checks and a few last questions that I want to start asking myself before I make an investment. And also for each of these points, I've added a few notes just to kind of remind myself of things to think about, the things that were kind of running through my brain as I actually added these points to the checklist. So the first one I have there, this is actually straight from Moat talk that he did at Columbia. Are there temporary tailwinds enhancing free cash flow? So a couple of examples I have there are things like maybe Netflix or Amazon during the pandemic. They had a lot of demand probably pulled forward, and a lot of subscribers in the case of Netflix that maybe wouldn't have subscribed if there hadn't been a global pandemic, and we don't really know how durable those subscribers potentially are. Same thing kind of goes with maybe short-term booms in commodity prices like lumber, for example, in 2021. So I really want to try and avoid a situation where I'm potentially overstating what cash flows you might expect out into the future. So that's first point on the checklist. list. Second one is from the After Dinner Investor, actually, and Guy Spear talks about this a little bit as well. Does the business produce actual cash, not just accounting profits? And I actually hate to pick on Netflix here, but I have picked Netflix again. So Netflix is a classic for this. They produce, positive earnings if you look at their income statement or their profit and loss statement, but they're constantly spending mountains of cash. Almost always have negative free cash flow and almost always have a growing amount of debt because they're constantly spending money in order to produce new content. And a lot of that kind of spend, that capital expenditure, doesn't flow through the income statement. So although they're showing accounting profits on the income statement, there's not necessarily a lot of new cash turning up. So that again is a situation that I want to kind of steer clear of. That's not to say Netflix won't work out as a phenomenal investment over the long term. I think it's got a good chance of doing very well, but that's something that I just want to be aware of. So that's the second one on the list. Next one is, could domestic or foreign competition ruin the investment case? Now this is a pretty straightforward one. The classic example is Dexter Shoe, an investment made by Berkshire Hathaway where it was largely a US-based shoe business, and then they were disrupted by cheap overseas labor, and that basically ruined the entire business. So that is a situation I would like to avoid. So that's that one. Next up, can I list the key factors that allow me to make sure the business is on track? So I think in a lot of cases you can study a business for a long time and you can get very complicated about it. And I want to just come back to kind of first principles with that particular business and be able to explain basically to like a 5-year-old or maybe an 8 or 10-year-old, I don't know. But I want to be able to explain simply the key drivers for that particular business. So I've listed Facebook as an example here. The key things I would focus on with Facebook would be what do the monthly active users look like over time, how much revenue do they generate per monthly active user, and what are maybe the operating costs per monthly active user. Those are kind of the key things that drive a business like Facebook, and I just want to have clarity on those key factors for any business that I'm looking at the time. Now the next question on the checklist here could arguably be in Moat, but I think it still speaks to understanding the business to a large extent as well. And that is, does the business have pricing power and or is it a low-cost provider? So if it can't lift prices up kind of at will, does it have some sort of moat around it from being the low-cost provider of that particular service or commodity or whatever it might be. So the example I've got here with pricing power is Norbert Lu's investment, and I think it was an Argentinian beer company. So he found a lot of kind of untapped pricing power that the business hadn't yet used, and that did great things for the investment case. So I don't want to be really stuck in an industry or a business where you're at the mercy of your dumbest competitor. I guess airlines probably is the classic example there, where if a competitor airline pulls their prices down, you've kind of got no choice but to do the same thing, and it's just kind of a race to the bottom and sort of erodes everyone's margins over time. So again, a situation I want to avoid. So next one on the list, are future capital expenditure requirements reasonable, and will they earn a high return on invested capital? So the example I've used here is with Fiat Chrysler, now called Stellantis, and I guess you could lump a lot of traditional automakers into that category. So the traditional automakers are likely to have a lot of capital expenditure over the next few years. They're kind of all eventually going to have to transition from internal combustion engines to electric vehicles, and that's going to cost a lot of money. And when they get out the other side of that process, I don't really know that they're going to be earning substantially more profits than they were with internal combustion engines. So that's a lot of future capital expenditure that's going to come up, and I don't really think they're going to earn that high return on it. I could be very wrong, but that's kind of my opinion at the time. And again, situations I kind of want to avoid. If a business is spending a lot of money on capital expenditure, I want to see them earning a strong return on that. So that's the next one. And does it have a long runway? Pretty basic one here. Can it grow at high rates for a very long period of time? Ideally with limited amounts of capital required to achieve that growth. And this comes straight from the book 100 Baggers by Chris Mayer. So, a typical journey, if you're going to get 100 to 1 return on an investment, which is spectacular, is you're probably looking at 15 to 20 years or more to actually hold that investment. So, if you're going to hold a business that long and it's going to reach the mythical 100 bagger status, you're going to need a very, very long runway for growth, and it has to have in my view, a pretty clear path in terms of how it's going to keep snowballing and keep growing at a high rate. Okay, so moving on to Moat now. Does the business have a clear and durable advantage over competitors? So again, a pretty straightforward one, just straight up asking, does the business have an advantage? Does it have a moat? And it's one that can come in, I think, a few different forms. So the example I've given here is Apple. They have kind of a couple of moats, I would say. So they have the brand, people are willing to pay a premium for Apple products. And they also have switching costs, or more, it's kind of just a pain to switch. So if you were to switch from an Apple device to, say, a Samsung device or something, getting all your contacts and your music across and all that kind of stuff is just a bit of a pain. If you use iCloud as well and you're in the ecosystem and you've got all your files and photos and videos and stuff saved on Apple's cloud services, it's really just a pain in the backside to kind of switch across to a competitor. So I want to be really clear on what those competitive advantages are for a particular business, and then that way, if anything changes in those areas, it's a relatively straightforward exercise for me to actually see that, because I've listed it out very clearly. This is what I think the moat is, and if that moat is breached, I can identify that more easily. So that's the next one. Next moat question we have is, could the moat be breached with enough money or technology? So I've given a couple of examples here. The first one is something like BlackBerry. So we all kind of know what happened to BlackBerry. It was a super popular phone in the maybe early 2000s, 2006, 2007, and then the iPhone and a bunch of other smartphones basically killed the BlackBerry. So I don't want to be at risk of technological disruption. And the point I'm trying to get at there, with enough money, is, if you gave someone like billions of dollars, could they just keep spending money? Is there a point at which you could give someone enough money that they could spend and disrupt your business? So an example of a company where that's probably not possible would be Coca-Cola. If you gave some random cola company or some random beverage company enough money and they just spent like hundreds of billions of dollars even, I think it would be really, really difficult to disrupt the Coca-Cola brand. So that is one that is definitely protected from both technology and people with very deep pockets. So I want to make sure that I'm getting into businesses that have those same characteristics. Next up, can an idiot run it? That's a pretty straightforward one. I guess the way Moat Proprietary might word that is, does the CEO have their feet up? Do they have their feet up on the desk and the business is kind of just doing its thing? This sort of comes from the whole, I think it was Peter Lynch initially that said, you should invest in a business that an idiot could run, because one day an idiot will, and I don't want to kind of be at the mercy of a CEO. So I want to have a business that's really kind of simple if possible, and a lot would have to go wrong for that business to kind of get off the rails. So Coca-Cola is the prime example there that I've used again. They've had some pretty bad CEOs, I think, throughout the last maybe 50 years, and they've had some great ones as well, and it's survived both, and it's done well on both. So if I can buy a business then that idiot could run, because one day an idiot will, that is a very nice thing to have. So next up, this is a pretty straightforward one. So this actually just comes from, again, Moat Proprietary. And this is actually part of his kind of two-part selling checklist. So is the business getting better? That is a pretty straightforward question. So we're looking at the earnings and the cash flows and, identifying those moat kind of characteristics for the business and making sure that they're all kind of headed in the right direction. There are examples where I would probably ignore that point on the checklist if I was buying into more of the 50-cent dollar type investment and I thought I could get a lot of capital off the table, very quickly, and there's some protection in that way. But most of the time I want to be buying into a business that's getting better. So the example I have used is Costco. Basically, the moat for Costco gets wider with every store they create. So the model at Costco is to be the basically low-cost provider of groceries. And the more stores they build and the more kind of economies of scale they can get, the harder that they are to kind of compete with. So the business is kind of getting better with every new store that they're able to open. Okay, so moving on to the management section next. Is management compensation egregious? And the example that I've listed here is actually Snapchat. So this one that I put on Twitter the other day, I had heard people talk about a lot of share-based compensation and a lot of shares being issued with Snapchat before. And I'd never really looked up the numbers, so I went ahead and did that. And I saw that not the earnings of the business or the cash flows of the business, but the share count, the number of shares outstanding for Snapchat, had been compounding at like 17% a year since IPO. So I really, really want to avoid situations where there's just these crazy like management compensation setups and, they're really diluting minority shareholders, or they're just spending way more money than they should on compensation, which again is kind of bad for the minority shareholders. That's not a situation that I want in my portfolio. So that's what I kind of mean by that. Next one on management, management incentives aligned with shareholders. So this is an interesting one, and this is kind of a difficult one sometimes to tease out. You can look at proxy statements and so on and see what management compensation packages look like. Again, you can kind of argue that things like stock-based compensation, align incentives with shareholders. But again, if it's egregious, like in the Snapchat situation, then I don't think that's that aligned with shareholders. The other thing I would pay attention to is, are there any kind of key business metrics that the manager is incentivized upon? So are they incentivized for revenue growth or for gross profit growth or net profit growth or earnings per share growth? I think it's important to understand those things because each of those different incentives can, incentivize obviously the manager to do different things. So if they're incentivized on total revenue, maybe they look to do stupid acquisitions, and that's not what you want. Maybe if they're incentivized on earnings per share, they might be incentivized to do buybacks, share buybacks even at egregious prices. Whereas, you see a lot of the Berkshire Hathaway managers, for example, and incentivized on things like return on equity or return on invested capital, which, it's kind of hard to work around those metrics without being very, very shareholder friendly. So that is also something that I am looking for. Okay, so next on the list are insiders buying. So with most companies in the US, you can look them up on a website called Open Insider. You can just search the ticker of that particular company and you can kind of see the activity for that business. So whether people are buying shares or selling shares as insiders in the business. With a lot of these points, and this one in particular, I won't necessarily, only invest in a business if they pass every single point. I won't only invest in a business if there's insiders buying. But a lot of these things are kind of prompts to just check stuff that I might not have checked already or might not have thought about before. So our insiders buying is definitely one of those. If there are insiders buying, particularly buying in size, that is often a really, really good sign. There's a lot of reasons why a manager may sell shares in a business, but there's really only one reason why they buy shares in their own business, which is, they think they're cheap and they think they're going up. So the example I have here is Bob Martin, who is the CEO of Thor Industries. He was buying Thor Industries stock in late 2019, and looking back, that was a very good price to be doing that sort of thing. So that is what I mean by are insiders buying. Next one we have, are management unreasonably diluting shares? So this kind of again ties in with management compensation sometimes. So Snapchat again might be a good example of that. But it can also tie into acquisitions. So if people are issuing stock to, buy other businesses and try and grow their revenue that way, that can sometimes be a red flag for me. In some instances, issuing shares can make a lot of sense. But if I'm trying to buy into the business because I think the shares are undervalued, it's pretty unlikely that I'm going to be a fan of, issuing shares to buy businesses and try and sort of grow the pie. So that would certainly be a red flag. I'm not completely against diluting shares. If the shares are getting diluted at like 0.5% per year because of management compensation, that's not the end of the world. But if they're compounding at some crazy rate, then that is definitely a red flag. And finally on management, is the strategy for allocation of surplus capital clear? So in other words, when the business earns money or generates free cash flow, do I have a very clear picture of what is likely to happen with that cash flow? So the example I've used here again is Thor Industries. So they do have a very clear capital allocation strategy, which they list in, I think, pretty much all of their investor presentations that they do every quarter. So firstly, they want to fund the underlying business. Secondly, they want to pay Thor's dividend, which they've done super consistently now, and they've grown that over time as well. Thirdly, they want to repay debts. And finally, they opportunistically, so they're paying attention to price and so on here, they're opportunistically either making acquisitions or buying back Thor stock. So there you have it. That is sort of the first half of my investing checklist. It's sort of an evolving beast and something I'm sure I'll add to over time. But that gives you sort of the meaning, moat, and management components of the checklist. In the next video on the channel, I will go through the final two parts of the checklist. So margin of safety, big focus on, what's the downside, what's the upside, how am I thinking about valuation, and then also sort of some final checks, which I have some interesting questions on there as well. I do hope you enjoyed it. If you've got your own checklist and you think there's any big points that I might have missed, definitely drop them down in the comments below. I mean, keep in mind that, like I say, checklists are quite a personal thing. So this is really, Investing with Tom's checklist. Your checklist will be different because there will be things that, you think about that I don't, or that I think about that you don't kind of automatically. So yeah, that's a nice starting point for you though, hopefully at least. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe. But that's it from me, and I will see you in the next one. Cheers.